There's been a lot of discussion in recent times about the ability of bonds to provide the defensive characteristics that they have provided to portfolios over the past 20 years. Obviously, the low starting point on yields does affect their ability to provide an offset to any decline in equity markets. For example, if we look at the current portfolio, say of a 60-40 portfolio, 60% growth assets, 40% defensive, if it suffered a 10% decline in the risk assets in that portfolio, it would require a more than 200 basis point decline in bond yields in order to offset that decline. In the case of Australia, that would mean bond yields moving from around about 0.9 to more than -1%. So it is difficult to see that occurring, although we cannot rule out negative cash rates and bond yields, as we've discovered in a number of other countries. But in this video, we're going to have a look at the role of bonds. We're also going to have a look at some of the other asset classes and exposures and investigate to what extent they can provide some additional defensive characteristics. So in the chart in front of us, what we're looking at here is just the US market going back to 1970. And I guess the approach we're taking here is to think of defensiveness as a characteristic or an attribute that an investor requires in major market downturns. And so what I've highlighted in this chart is previous bear markets in the US. So you can see them going back to the 1970s, some quite short and shallow, some obviously much bigger and much longer. But they're the events that we've chosen. And if we express that in terms of a cumulative decline in each of those bear markets, that's the S&P 500. So you can see that there. So let's just start with bond yields and look at what's happened to bond yields in these previous bear markets. And we'll choose the US Treasury and we'll look at it in original terms, in fact, and doing that here. So this is now the chart of the US Treasury bond yield. And you can see those bear markets in equities occurred in a rising bond yield environment in the early 70s and once again in the early 80s. To some extent, the 87 crash was associated with a rise in bond yields, but really progressively since then, bear markets have been associated with steadily declining bond yields to new lows. If you think of that in terms of basis point movement, what stands out is there's two different occasions where bond yields are actually rising. They were causing bear markets, inflationary related bear markets, and then of course the more deflationary recession type bear markets where bond yields actually declined. So, looking at the starting point of bond yields today, you can see these are the previous starting points for bonds in each of the previous bear markets. And so here we are today with bond yields now down below 1%, so an extremely low starting point, as you can see. So basically, as I said, we've had three occasions where bond yields declined, two occasions where they'd increased, and the other two occasions broadly sideways. What about in terms of bond returns? So if we consider it in terms of in nominal terms, once again, the most recent bear market that lasted only really 3 months early this year, bonds actually provided about a 9% return. This is just out of the 10-year bond market in the space of 3 months. So it's quite an extraordinary performance, and followed a path similar to that of the 2000-2007 bear market. So it did its job. On other occasions, as I mentioned, in the 70s and the early 80s, it didn't really do its job, as you can see there. And in fact, in real terms, if we look at the performance in real terms, we see that even more stark underperformance. So bonds provide diversification, yes, and can continue to do so in deflationary environments. Bond yields can go negative, as we've seen in a number of countries, but certainly their ability must be limited. And on the other side, if a bear market is associated with a steep rise in inflation, as we saw in the 70s and 80s, bonds do not provide the protection. So let's have a look at some other possibilities. And I'm going to first look at currencies. So what we might do is take out the currency. We'll only look at the post-float periods. So I've removed 84 or prior to 84. So this is the performance of the Aussie US dollar rate during those bear markets, and by and large it's been a decline in the currency, and that's provided some diversification benefits to Australian investors. Not so much the case in the early 90s in a more limited bear market, but in the previous, the other four bear markets that we're looking at there, the Aussie dollar has provided an offset. So it certainly should be part of the defensive toolkit. We can also look at Australian dollars performance against the yen. Didn't work in 2000, but did have some benefit during the other periods. And then, of course, often Swiss franc is also seen as a defensive currency, and that's been a fairly consistent performance, the Swiss franc rising against the Aussie dollar in those bear markets. So currency potentially provides another source of defensiveness. Let's look at gold prices, and we'll look at gold in Australian dollar terms, and that is coming up shortly. So that's the performance of gold in Aussie dollar terms. We might want to look at that in real terms, which I'll do right now. So in real terms, you can see that the performance of gold in the previous bear markets are only going back to 87 in this instance, but it certainly has provided a bit of an offset. A lot of that, as I said, though, really coming from the performance of the Aussie dollar itself. If you look at it in US dollar terms, US dollar real terms, it's been somewhat mixed and a lot more volatile. But obviously in Aussie dollar terms and real terms, it's been, generally a positive experience. So gold has appeared to have offered some sort of defensive characteristics. Another area that investors consider is performance of hedge funds. So I've just taken a very simple hedge fund index, and obviously the data doesn't go back quite as far, but if you look at a broad hedge fund index, really it did provide some offset during the bear market of 2000, but wasn't the case in 07, and certainly wasn't the case in the bear market earlier this year. It improves somewhat when you begin to look at, say, the macro component of the global macro hedge fund space, and also there's some other strategies that have managed to perform reasonably well. One interesting, comment often made is that hedge funds are, highly correlated with the equity market, and that does seem to be the case. And what I'm going to have a look at here is just the correlation of the global macro index with the US S&P 500 12-month rolling returns. And if we just look at that correlation, you can see that, yes, most of the time it's quite highly positive, but there have been periods, and these periods really have been associated with downturns in the equity market, where the global macro space and some other strategies in the hedge fund space have provided that protection. So be careful about looking at correlations. The correlations might show they're mostly positive and high, which is not really a diversification characteristic, but in downturns they have provided at least some benefit, although the data is not that extensive. Real assets is another area. So if we just go back here, and we'll just go back to events, and we'll have a look at, say, infrastructure. We don't have a lot of data going back there, but clearly as a listed infrastructure class, whether it be the S&P Global Infrastructure Index or the MSCI Infrastructure Index, you can see the last two occasions, certainly, returns have been very heavily negative. So on the surface, at least, listed real assets haven't provided any support. If you have a look at some measures of unlisted, as we do here, this is an unlisted component, but it's in Aussie dollars, and that's sort of shown, flat to slightly or to positive returns, particularly in 2000. But they've benefited from, massive declines in interest rates over that period. So very much the defensiveness characteristics have been associated with the big declines in bond yields over that period as well. So which leads us to just consider one other area for now, and that will be just looking at various styles or factors in markets. And one might expect defensive sectors to have performed reasonably well. Again, though, this is not in absolute terms. They too have fallen, as you can see here on the previous 3 occasions, falling by 16% in the most recent downshift. On a relative basis, of course, they've stacked up reasonably well, as we can see here. They've outperformed the overall MSCI index. But at the end of the day, if it's defensiveness and it's absolute defensiveness that you're after, then these don't have a great track record. But having said that, can form part of your line of defense in the growth part of the portfolio. So quality is another one. You can see here, quality has also declined in fairly heavily in previous bear markets, but on a relative basis has managed to outperform. We will leave it there, and thank you for listening.